In this video, traders, I want to talk about the difference between the market order and the limit order. So this is perfect for you if you're relatively new to trading and you're trying to work out what the best order type is for you to use in your personal circumstances. Stay tuned. Hey guys, warm welcome to you. Thanks so much for joining me. If you're into trading, you'll love the videos I have for you on this channel. In this video, I want to talk about market order versus limit order, and you might have seen these around, and maybe people have different kind of opinions on which to use and stuff. I'm going to give you the kind of facts, and then I'm going to kind of give you an idea of how I think each one could be used, and you can kind of go away and go, hey, you know what, that makes sense. I might implement that. Or you might go, you know what, 3 minutes of my time, I didn't really get anything from it. I don't think that would be the case. I think I'll hopefully provide you with some value. So market order versus limit order. The standard things that we all know are this, is that when you place a market order, you are effectively saying to your broker, let's assume we are buying 100 shares, and it could be 100 lots if your futures contract, one lot if your futures contract, it could be a currency trade that you're doing, GBP USD, in terms of, it could be lots, it could be in CFDs, it could be a spread bet, whatever the unit is, doesn't matter. But what we're basically saying as a market order is, and let's use an example, 100, buy 100 of this instrument. And a market order effectively says, I don't care about price, I just want to get in. And so with a market order, you lose price control completely. Now you might see on the screen on your ticket something like, I don't know, quoted at 50.51, right? And generally you'd see that that's your bid, that's your offer or you're asked, and you go, right, I'm buying, and you're looking to buy, and you hit the ticket and it's currently at 51. Now, if the price moves between the time you hit the ticket and the time it goes to the dealer, goes to the exchange, if it's going direct on the exchange, or if the dealer's the counterparty, comes back, if the price has moved, if you're using a market order, you're basically saying fill me at any price. So you've watched the market, guys, you know how much the market can move, and it's constantly changing depending on the market you're watching, of course, but some of the bigger markets constantly moving and changing. So you hit market, by the time that fill gets reported and comes back, you might get filled at 53. Right? But you're filled instantly, because that's what you're saying with a market order, is I want instant execution at the potential for me to not get the price I want. But similarly, and all brokers should do this, and pretty much all of them do. By the way, you can check out our sponsored broker in the description below if you're looking for a broker. If the market moves lower, and you're buying, you're going to get filled at a better price. And so you lose price control completely, but you have speed. And so that's why people use market orders. They want to execute now. There's a reason for them to execute now. What will that reason be? It could be that they think, or you think, the market's about to catapult to the stratosphere. It's about to go. You can feel it break, about to break, and you want to get in quick. You don't want to wait for a better price. You don't really care for 52, 53, 51. You just want in because you think there's going to be 60 in the next 60 seconds, or it's going to be 70 in the next 10 minutes, or whatever it may be. And so you're prepared to give up that price control. Okay, so you get time control, you get price control. Now, I also talked about slippage. You get a lot of slippage potentially with a market order if it's a fast moving market. Let's move to limit orders. So a limit order basically says this. It says, hey, I would like to buy 100 shares, as we're talking about as an example, of this company, and I'm only prepared to pay a maximum of this price. And imagine if you're using a limit order, let's say using a limit order at 50, right? So you're buying 100 at 50. Okay, that's your limit order. So what the limit order is basically saying, that's the big shift between market order and limit, is, hey, I am very price sensitive. I care about price. I do not want to pay 51, 52, 55. I don't want to pay that, but I want to pay 50. However, we get this balance in trading as always, yin and yang, something's got to give somewhere or another. I have to be prepared to potentially wait for that. So you could place your limit now, but if that price isn't there, you're not going to get filled. But the limit order is saying, I'm price sensitive, I'm not time sensitive. A market order says, I'm time sensitive, I'm not price sensitive. We'll talk about in a moment which one you might be depending on the type of strategy you're deploying. Okay, so what would happen now if you put that in a buy order limit 150? It wouldn't get filled because the ask is 51. And if you're going directly to the exchange, you'd be put on 50. If you're trading a spread bet CFD, you'd have to wait until the price moved down to 49.50. When it did, that limit buy would be filled. Ding, you've got your 100 shares, your 100 contracts, whatever it may be. But you've had to wait. The downside, of course, is if it moves up to 51, 52, 52, 53, your limit is sitting there unfilled. Sorry, you didn't get filled because you wanted 50 and it didn't give you 50. And so those are the kind of main things. You have to decide if you're price sensitive or time sensitive. If we kind of wrap it all in a nutshell, those are the two things. Oh, by the way, of course, you're not going to get slippage. You're either going to get positive slippage if the market suddenly moves. A rare occasion you might get positive slippage. Example would be if you, and this is really unusual, if you put a buy limit in at 50 and by the time it hit the market, that was already quoted at 48.49, for example. Give you an example here. You put that order through, it would fill you at 49 because that's the best available price that's below 50. So there's other circumstances as well, but that's probably the most likely one if you have that. Otherwise, it'll be filling you at 50, right? It won't fill you anything above 50, so you don't get any slippage. If you do its positive slippage, it works in your favor. All right, so time sensitive, price sensitive. When might you use these? You might say, okay, hey, I am using a very time sensitive strategy. Let's say you're trading a breakout, okay? And you're there and you're watching, you kind of see it nudging against the high, and a breakout is kind of when it breaks through a key level, and the hope is that it gets some sort of explosion, some sort of extension of the move. If you're watching that and you see it break, you might be like, hey, I want to get in, but I know a lot of other people are trying to get in at the same time. I don't really care what price I get, I just want to get in. You might use a market order for that. You might say, hey, the urgency is more important than the price. I need to get in because it's about to go instantly. I don't want to miss it. Now, of course, if you're late, you're going to get a worse price, but you might just want to get in. And so that might be why you want to use a kind of limit or a market order, should I say. Now, a limit order, let's think about what you might want to use a limit order for. Now, a classic example I want to give you is kind of sitting at a support level, but okay, let's scrap that. That was the one I was going to give you, but let's go in the real world, real trading for a second. Imagine if you are, this is a beautiful little setup if you can get it right, a little flush exhaustion type trade. So imagine we have, can we see it on the chart? Yes, we can. Imagine we have a kind of level here and it's sitting here and you want to buy when it kind of flushes through. So it's an exhaustion type trade. You, rather than the breakout trade, you think, hey, if it flushes through, I want to buy that for a real pop back up and maybe you're going to sell it up here. Quick scalp, 15-second scalp type trade. Okay, so the issue is, when it flushes through, and we'll maybe get a bit advanced here, hey, let's just real world stuff for a change, rather than all the other textbook things that a lot of people tend to put out. Textbook. Yeah, real world is slightly different. Let's go real world. As the market flushes through, what happens is it leaves a big kind of void on the offer. And so as it's kind of pushing through, it hammers lower. And then if you were to buy market, or everyone else is buying market, you might get awful fill because there's just no liquidity there and it snaps back up so quickly, you might end up getting filled here, which null and voids the whole trade idea, right? You're trying to look for that exhaustion, the final vomit of the position, the stop's getting pinged, people getting pinged out. And you're like, yeah, I'm going to buy that. That feels like the last of the sellers coming in. Yes, you could get away with the market if the timing's right, but again, it's just an example for you. If you don't, you're going to end up buying here because there's a vacuum left, and that's kind of going to the intricacies of the order book. I'm not going to go too far into it, but just know that when there's a market order hitting the bids, it leaves a lot of a void on the underlying exchange on the offer. You come in with a market order, you on your own might not do this, but if a lot of people are coming in, it's going to run straight back up and you're going to have awful fill. You might say, okay, actually what I want to do is I want to smash a limit in that's a little bit higher than where it's pausing. So let's say the market's coming down to 40, you see it come down, it's like 50, 49, 48, 42, 40, and it pauses. Rather than using a market order, you might go rank limit by 44. Okay, you might say, okay, I'm prepared to pay a bit higher, and what that'll do is it would take everything up to that 44, and you might get a partial fill, you might get 3/4 of what you want, but you're not going to get an awful fill back up at 59 or whatever it was when it fell down from. You're going to still be kind of aggressive and kind of going in there and using a limit that's higher than the current stated price. But if you get a fill at 40, fine, great, you've got the fill at 40, but what you're not going to do is get an awful slippage and goes back to high. So that'll be a kind of real world exhaustion intraday example that you'd probably play on any kind of instrument. And that might be why you would use a limit order. The kind of traditional textbook example I was going to tell you, I'm supposed to tell you that as well, it would be, let's say you want to buy at a certain level, key level. You're like, okay, it's very, very strict. I want to buy that key level or I don't. And so maybe the market's kind of fast market around that key level, but you're saying, hey, I just don't want to buy the key level because it ruins the risk reward structure of the trade. If I don't, you would just lose a limit order for that and say, hey, I'm prepared to wait, I'm prepared to risk not being filled at all, but I do actually want to get that specific price. And did I mention that again? I think I did. You might not get a fill at all. I'm sure I did. I must have done. Tell me I did. Guys, tell me in the comments I did. Pretty crucial part of limits is that a market order guarantees you'll be filled. Just could be any price. That's basically what it's saying. Fill me at any price. Limit order, you could just not get filled. It doesn't hit your limit. It doesn't specify the level that you've set out for it to trigger at. You may not get filled forever, potentially. Now you might have to wait as it comes back and forward in the real world. Maybe it goes up a bit, comes down a bit. If you're patient enough, you might get it if you still want it. Or it could just kind of chug off and off and off, and you might not ever get that fill. So something to be aware of. Price sensitivity, time sensitivity, adjusting the tool for the right trading conditions and strategy you are deploying. If you like this video, I appreciate a like, and thank you for watching. See you again soon. Take care. Keep your risk managed. Bye bye.